Personal finance guru Tony Robbins says you need this investment in your portfolio. He's talking about bonds. He calls them, quote, the foundation of a mind-blowing portfolio that works in all economic climates. Nolan, do you agree? Is there a place for bonds in today's retirement plans? And if so, how does a retiree go about utilizing them?
Well, if you go back to the good old days and you think about, how portfolios were structured years and decades ago, bonds were oftentimes the cornerstone of retirement portfolios. The question is do they still make sense today? Really what I want to do is kind of break down the pros and cons to help you figure out if they belong in your retirement portfolio. First of all, if you go to the website morningstar.com, one of the things that you could do is you could look up the U.S. Aggregate Bond Index. That's just a broad measure of the bond market as a whole. Now, there's all different types of bonds that are out there, but using the broad U.S. Aggregate Bond Index, according to Morningstar, as the date of I was recording this, for the past 5 years, that index is actually negative 0.46% per year on average. And in fact, if you look at the 10-year average, that index is only up about 1.83% per year on average over the past 10 years. But here we are, we're in a little bit of a different interest rate environment. What you have is you had interest rates that went up quite a bit. You had obviously concerns about COVID, but now we're in an environment, where interest rates are starting to go down. So it's the time to take another look to make sure if bonds make sense in your portfolio. What you want to do is, first of all, consider what are some of the positives of a bond in a portfolio. Bonds have the ability to provide more stable income. They could provide more predictable income than, say, just owning growth stocks. They can help you out if you're looking to better budget in retirement time. And I know income and stable income in retirement is a goal for a lot of retirees. Number two, because of that stability of income, the day-to-day price, or what is known as the volatility of the stock or bond market, becomes a little less relevant. When you are relying upon stocks for growth, that volatility can impact things. And when you have more stable income, it can make a positive of a bond fund. If you hold the bond fund and you own an individual bond fund, if it's held to maturity, whoever is issuing that bond, be the corporation, the municipality, or the government, you can get some capital preservation with the backing by who has the bond and who issued the bond. It does help with diversification. I'm a philosophy of don't have all your eggs in one basket, but absolutely you got to know what you own. And number 5 is you can get some tax benefits with certain bonds. So if you have taxable accounts, there could be an advantageous reason why you'd want to consider some of the income benefits of like tax-free municipal bonds. What some of the negatives are, or some of the cons about having bonds in retirement time, is number 1, lower growth potential than what you have with equities. They have historically underperformed the stock market over the long run. Number 2 is you have interest rate risk. So the Federal Reserve, has talked about what their plan is to lower interest rates in the near term. That could be a positive thing, but again, the bond market is an auction, meaning that the more people show up to buy, the higher the price goes, more people show up to sell, the lower the price goes. You have some interest rate risk that's out there based upon what happens with interest rates, but more so about what happens with that being an auction price overall in the market. Number 3 is you got to pay attention to credit risk. For me, I believe that it's very important to have high quality companies that you own, whether it's stocks or bonds. Be careful what you own right now. High yield bonds might seem attractive because maybe they're going to pay out more income, but it could be because of the fact that you're investing in companies that have very poor credit and run a greater risk of default. So consider about what could happen if we had a major economic downturn in the credit risk that you face by owning the wrong type of bonds. Number 4, they can be callable. So if you have great rates and then all of a sudden rates go down, kind of like what they're doing right now, the bond could be called early, and that could leave you in a situation where you have to reinvest at lower rates. So again, there's pros and cons to the bonds. Hopefully that helps you figure out if they fit into your portfolio based upon where we're at in the economic cycle. Know also that there are some alternatives that are out there as well. As an example, you could consider utilizing an FDIC insured bank CD. That could give you predictable income. That can give you safety. It can help reduce and eliminate some of the fees that you pay if you're paying fees and expenses on a managed portfolio in your bond fund. Number two, having a fixed annuity that can lock in a multi year rate guarantee. Now may be an optimal time to lock some of the high rates that we have in for the next 3, 5, or 7 years and utilize that where the income's not going to be callable, the income's not going to be changed. There are accounts that are also out there that offer no fees. And third is an index annuity can be another option if you want some growth potential, but still looking for that safety of principal. That can maybe offer a little bit more growth potential depending upon what is the structure of your fixed index annuity. So the decision to add bonds into your portfolio isn't necessarily black and white. It really depends upon what your individual situation is, what your risk tolerance is, and what your retirement goals are. It can be easy right now to get a little bit caught up with the stock market. We've had some great growth within the stock market. But again, while things are going well, is the time to consider, should you be a little bit more diversified? Is it time to maybe lock in some profits from some of your growth type of investments? Consider some other alternatives that can add in a little bit more steady income, capitalization of principal, and figure that out. One of the things that we do for you is we can do an independent portfolio analysis. So if you have bonds, if you don't know if you have bonds, or if you're not sure if you should add bonds into your portfolio, that independent portfolio analysis that we offer here at America's Retirement Headquarters will help you do a deep dive into your portfolio and understand, what could be the right mix for you.